Hello traders, and welcome to lesson number 20 in the ReadFX Beginners Forex course. In this lesson then, we're going to look at risk management. Now, before we start, most people confuse risk management with money management, but in my opinion, risk management is more about mitigating the risks in total. So from yourself, from your situation, from the market, all of that sort of stuff. It's not really to do with money management, and I'll do a separate lesson on money management. Now, risk management falls into the category of boring stuff, okay? But I can promise you that the boring stuff, this stuff here, is the stuff that makes the money. And the exciting stuff that everyone likes to watch on YouTube, people flexing, showing profits, magic candle patterns that never lose, this incredible strategy that no one knows about. You know, this is kind of the engagement that you'll get, is when people see the exciting stuff, they want to watch it. And the irony is that none of that stuff actually makes them money. Now, if I start posting videos about risk management, mindset and discipline, people's engagement and attention with that sort of stuff goes right down. And this is the stuff that really makes you the money in trading. So with that being said, let's get started with risk management. So risk management then can be broken down into two simple steps, okay? So first we need to identify those risks, evaluate them and prioritize them. Then we need to minimize the impact of each one of those risks, and we need to monitor and control it. So let's have a look at some examples. Now, we know that 80 to 90% of traders lose money, and what we have on the screen right now is a huge list of risks broken down into sections, okay? And I'm sure you can think of somebody you know, another trader, or even yourself, who has lost money for most of the reasons on this slide right now. So let's take a typical example, time. How many times have you seen people either miss a trade and not make money, or enter a trade and then not have the time to manage it and then lose money because of it? I've been with a broker that's gone bust. Most people don't even consider this kind of stuff. I was with Alpari, and I know a lot of traders who were, and when they went bust, our accounts were frozen for months and months and months. Some of us had profits that were reset, okay, and we never got paid out that money. Latency is a big one. If you have if you have a latency issue and you place a trade, you sometimes get in the market at a far worse price than you anticipated, and you take a loss because of that. And you know, the list goes on and on. If you just read these one by one, I guarantee you've either lost money yourself for these reasons, or you know somebody who has. So risk management then is about thinking of every eventuality, identifying all of the risks that affect your trading daily, and then making a plan on how you're going to address those issues. Okay, now I'm aware that most of you are probably finding this very boring, and a lot of people will have already left this video, and that's fine. So let me just show you how important risk management actually is. If we look at this slide from 2013, we see that Goldman Sachs had 236 profitable days of trading and only 15 days of losses. Now ask yourself, was this an accident? I think it's highly unlikely that Goldman or anyone could make money for 236 days in a year and only have 15 days of losses. This stuff is not an accident, okay? It's a result of careful planning and risk management. Do you think that Goldman have not got a plan as thick as a phone book to address every single one of these issues, and probably 1,000 issues on top of that? Of course they have. Every bank, every hedge fund, every institution has got a huge rule book essentially of what people are allowed to do and what they're not allowed to do. There's systems, there's processes, and this all stems from the risk management plan, okay? Do you think that if you got a job at Goldman or somewhere like that, you could walk in and place a trade on your phone knowing that you've got dodgy signal, you can't really see the screen properly? Can you imagine losing millions or tens of millions of dollars and having to explain to the floor manager that you were in a rush, you had to go and take the dog for a walk, you just placed the trade without looking? It just wouldn't happen. But that's what retail traders do all the time, and retail traders look at this stuff, they look at the boring stuff and think, well, it doesn't really matter, I'll just find a magic candle pattern that's going to make me some money. And that's why 80 to 90% of retail traders lose money, and that's why the banks and the institutions and the hedge funds do not. So hopefully this really makes the point of just how important risk management is. Risk management is way more than just how much you risk per trade, which is what most people associate with risk management. Risk management is about understanding your strategy, its strengths and weaknesses. Your money management is a part of it. But as well as that, yourself, your ability, your confidence, the whole thing, your setup, your brokers, your conditions, your spreads, your latency, the market, the instruments you trade, your sessions, your time frames, the current volatility, the sentiment, the volume in that market at the time you're trading. All of this is risk management, and all of this boring stuff is what makes you the money. Okay, so let's have a look at evaluating risk. So what I've done is I've just taken the trader column and I've picked two really common ones. So time and resources. And what you want to do now is evaluate them, just expand on them a little bit. How many hours do you have each day to find, enter and manage trades? What's your working hours and your shift pattern? Think about your daily routine. How many times have you put a trade on and then you've had to go on the school run or walk the dog? And as a result, you didn't manage that trade in the way that you would have, and you didn't get the result that you were expecting. You know, this is the reality of trading. These are all risks and you need to evaluate and manage them. Resources. This is a big one. Fast, stable internet connection. How many times have you been trading from your phone and you've lost signal, or your Wi-Fi goes down, or something like that? Is totally avoidable, and you need to plan for it and eliminate it. Dedicated PC. If you're sharing a PC at home and you can't get on it to trade, that's an issue. You need to have a plan for that. Lastly, money to trade with. And I don't just mean having money to trade with, I mean having enough money to trade with. If your strategy is an averaging strategy and you need to keep adding trades, you're using up more and more of the money in your account for margin. So if you only have a small account, don't trade that kind of strategy unless you have more money to trade with, okay? Next, we need to start prioritizing. So now that we've identified and evaluated the risks, we need to put them in order of importance, okay? Obviously, I'm not going to do that with each of the ones on this list. It'll take forever. But that is what you actually need to do. You need to prioritize and then start to address them. So what I've done is I've just put these in order of importance. Obviously, if you don't have a fast, stable internet connection, I wouldn't even try to trade. You're just going to lose money. If you don't have access to a PC or a server and you're just trading from your phone, again, I wouldn't even try to trade. You're just going to lose money. And if you don't have enough money to trade with and you're going to keep getting margin calls or exiting trades early, again, you're just going to lose money. So finally, let's get on to the actual minimizing the impact. Now, think of this as finding solutions to the problems and crossing these items off your list. So if we look at the example of a fast, stable internet connection, what can we do to improve this situation or get this crossed off entirely? Use a LAN cable or an Ethernet cable. In other words, plug in instead of using Wi-Fi. It's a much quicker, more stable connection. Increase your broadband speed if you can, contact your provider, pay an extra couple of pounds or dollars a month and get a better service. Reduce taking trades from your phone. If you go out and about and you're in an area with bad signal or no signal, don't trade. It's just going to end badly. Overnight and weekend risk, okay, so this is another common one. Gap risk. If stuff happens overnight or at the weekends, news events for example, the market can gap hundreds of pips, okay, and it will jump your stop losses and you can lose your entire account in a weekend very easily. So how can we fix that? Well, you can make a plan to close your trades before the New York close each night to avoid rollover issues. You can close trades before the New York close on Friday to avoid weekend gap risk. Now, if you don't want to do that, you can look at other options. You can keep your trades open but do partial closes. You might choose to reduce your exposure by closing half of the trades you have open. You could also hedge your positions so that no matter what happens, you're going to be in that same position on Sunday night when the market opens. You could even see if your broker offers a guaranteed stop. Now, guaranteed stops, even if there is a gap, your broker promises to let you out at the price you set your guaranteed stop at. So that's another option to minimize the impact of this risk. In this lesson then, we looked at identifying risks and minimizing the impact of those risks. So in a nutshell, this was risk management. In the next lesson then, we're going to look at money management.